In today's episode, we're going to talk about how do real estate agents or real estate professionals pay less taxes in California. So we're going to talk about a strategy that includes bonus depreciation. We're going to talk about what qualifies as a real estate professional, talk about cost segregation studies, and the different benefits tax-wise of investing in real estate. So one of the challenges that I had when I got started in real estate was that I always heard that real estate had tax incentives, but I actually didn't find out what those tax incentives were till about 8 years of being in the business. To help us with that, we got a repeat guest, Mr. Jimmy Vreeland. Welcome back to the podcast. How are you?
Hey, Jose. How you doing, buddy?
Doing good. Awesome. So how does somebody go about paying less taxes as an agent or as a real estate professional in California?
Well, it's really simple. I have a fundamental belief about this great nation of ours. And do you know what it is?
Tell me.
It's a country founded by real estate investors for real estate investors. A lot of people look at the tax code and they get upset by it. I look at it as a complete treasure chest. Mm-hmm. And for the 250 years this country's been in existence, they've always supported people who are going to provide safe, clean housing to their citizens. And so, thus, they give massive tax breaks to all real estate investors.
I love it. So what qualifies as a real estate professional?
Well, the simple qualification is you're a real estate agent or a full-time investor. The IRS has different qualifications, but basically you have to rack up 750 hours in real estate activities. Now, non-working spouses of a lot of my clients we've been able to get them to qualify as a real estate professional, but that takes extra steps. It takes some time. It takes at least 5 properties. I'm on your podcast today to just cut straight to the chase and be like, if you're already a real estate professional, why aren't you buying assets?
Got it. So even for like real estate agents, a lot of agents don't know this, but if they invest in real estate, they actually get massive tax write-offs. So let's talk about how does it work? Meaning like, okay, let's just assume that somebody qualifies as a real estate agent or is a real estate agent or puts in the 750 hours or is a real estate professional. How does this work?
So this is especially relevant. Like real estate's always been completely tax advantaged. But now since the Big Bold Beautiful bill passed and 100% bonus depreciation is back, the tax savings are absolutely ridiculous. Now, these 100% depreciation was in play between 2016 and 2020. So, like, Jose, I actually was a horrible business person when I first started, and I forgot to pay my taxes, but I had 100 rentals, right? And I forgot to pay my taxes one year, maybe 2, and I owed the government $250,000. And do you know what I did instead of paying them?
No.
I just did a cost seg study. There was bonus depreciation on the table, and I did this in 2019. And so I did a cost seg study on all 100 units. Took bonus depreciation on the assets, and it wiped out my $250,000 tax bill. And like, I was in a place of high anxiety before I understood the strategy because I was like, how am I going to pay the government $250K?
Yeah. Well, I think even for me, Jimmy, so I got hammered in taxes in 2017 where most of the money I had in my bank account went to the tax man. Yeah. And then I read a book by Robert Kiyosaki, and it talked about cost segregation studies.
Yep.
So what is a cost segregation? Well, let's start off here. Explain depreciation.
Okay.
And then how it differs regular depreciation versus depreciation if you do a cost segregation study.
Okay, so I'm going to go back in time. Can we?
Yeah.
I'm going to go back in time to the founding of the IRS in 1913.
Okay.
Okay, so in the economy, there was an income tax, which is on your income. But farmers and factory owners a farmer would harvest all their crops and take a profit. And the IRS was taxing all of that. But the farmer was like, hey, IRS, like, dude, my tractor's depreciating. All my farm equipment is depreciating. The factory owners were saying the same thing. Like, hey, you see my net profit, but you're not considering that my entire factory is breaking down and losing value every day, essentially, right? Mm-hmm. So the IRS said, okay, cool. We will create a carve-out called depreciation. So people who have capital assets, and we can accept that, hey, although you're not replacing them that year, you have your assets are depreciating, and you should be able to deduct that off your net income. Does that make sense what I just said?
It does to me. So basically, in other words, it's a paper loss at the end of the day, basically.
Yeah, that's exactly right. And now let's go into depreciation schedules.
Yeah, exactly.
So now the IRS has listed it out, and you can check it out on their website. There's different asset types that depreciate at different times, like a car, 5-year depreciation schedule. A tractor, 7-year depreciation schedule. Different farm and factory equipment, like relevant to people on this podcast in real estate. It's probably a car is a 5-year. Now, what makes real estate interesting is inside a real estate asset, you have different depreciation schedules. So you have roofs, which are on a 10-year schedule. You have HVACs on a 10-year schedule. But then you have the asset, the full asset, like the sticks and bricks of the house, that's on a 27.5-year schedule. And on a 5-year schedule is countertops, flooring, cabinets, paint, all the stuff that pretty much when you have a resident or a resident move out of a rental, you have to replace. Intriguing, and why you need cost seg studies for real estate is because back in the day before cost seg studies, IRS has said no. A piece of real estate depreciates over 27.5 years. But real estate investors and their lobby got together and be like, that's not true. In 27.5 years, I'm going to redo the kitchen 3 times. In 27.5 years, I'm going to redo the flooring at least 3 times. And so that's why they designed these different depreciation schedules.
Amazing. So basically, if I'm understanding correctly, you buy a piece of real estate for $1 million, you subtract the land costs, which
20%.
leaves you the building cost. So you're left with $800,000. Normally, on a residential property, you depreciate that $800,000 over 27.5 years, which means you get a write-off every single year for approximately 27.5. That changes with a cost segregation study, and they give different depreciation to different items in the house, basically.
Yep.
So how much is a cost segregation study, and then how does that play into the 100% bonus depreciation?
Okay, so like when did you start in this business?
I started in 2010.
So yeah, it's me about the same time. So 2010 through 2019, cost seg studies were really only for commercial properties because you had to send out an evaluator to walk each part of the asset, right? But real estate investors and their lobby have made it simple now that AI pretty much does it for you, and the IRS accepts it, and you can do it all online by yourself for about $250. It used to be a very substantial cost. And I think there's even websites like cost segregation study by you.com. I mean, Google it better than that, but I know people are in Collective Genius. That's what they're using now because it used to be pretty expensive.
That's amazing. Okay.
Yep.
And then let's say, that example that I gave where you buy the property for $1 million and you're left with $800,000. How does the cost segregation study change that, and how does that work with the bonus depreciation in that same example?
Yeah, so now 25% of that 800 is available for bonus depreciation. So what's 25% of 800? $200,000, right?
Yeah.
So back in the day, now let me slow down here. So before the big, bold, beautiful bill, that we have $800,000 left to depreciate, right? You would put that $800,000 on a 7-year depreciation schedule. So you divide $800,000 by 7. So it's 100 and change deduction per year, right?
I thought it's 27.5, no? Before the big, beautiful bill, or no?
No, before cost seg studies, it's 27.5.
Okay.
Before big, beautiful bill, it's divide $800,000, or sorry, divide about 25% of that $800,000 is on a 7-year depreciation schedule.
Exactly, yeah.
Sorry, so I fumbled a little bit there. So you would take $200,000 and you would divide it by 7. And what is that?
Maybe like 30.
28. 28.
Yeah.
So cool. You'd get a $28,000 deduction per year. Cool, right? That's
not life-changing, but it's good.
still cool, better than nothing.
Right.
Now with the big, bold, beautiful bill, everything that you used to take 7 years to depreciate now is in year one.
Exactly.
Which
So
is awesome.
in that example, you would get to basically write off $200,000, which explain how. Okay, so you get to write it off, but explain how that relates back to a real estate agent or a real estate professional. How does that help me if I get to write off? Because if I'm writing off $200,000 and my property doesn't have $200,000 in losses, how does that help me as a business owner?
This is why real estate agents have this like special free pass from the government. Most people, they divide their active losses and their passive losses, and they can't mix. And so most people are not real estate professionals. They take passive losses in their, these are high net worth individuals in their passive portfolio, but that does not affect their active income whatsoever. For no good reason other than this country is a government created by real estate investors for real estate investors. They have said, hey, if you have this real estate investor dispensation, then you can take your passive losses off your active income. No one else can do that except us, which is why I'm on this podcast today saying if you're a real estate agent and not taking advantage of this, you're bypassing the greatest tax savings instrument ever.
Yeah, because let's compare it. Let's say as a doctor you make $1 million, but let's say you don't qualify as a real estate professional. Even if your losses from real estate exceed the income, you can't use it to write off the $1 million that you made as a doctor. The only way to do it is if you qualify as a real estate professional. Yep. Now let's say you make $1 million here, and let's say you have $1 million in paper losses or depreciation. Those two can get wiped out to eliminate your federal taxes, basically.
You're living tax-free at that point and getting wealthier.
Yeah. Just a little testimonial for our viewers. I did this in 2019. I bought a $4 million building. I got $1 million in bonus depreciation that year. For the next $1 million that my real estate business made, I paid $0 in federal taxes.
How'd that feel?
It was unbelievable. It was like amazing. And the part that I questioned myself, Jimmy, I was like, how come nobody told me about this? That was the part that I was like, how come nobody told me about this?
Well, part of it was, Trump's first term, everybody was kind of, how's this going to work? How's this going to happen, right? But now everybody has 4 years of experience and knows. So now to me, it's like game on. Mm-hmm. And so why no one told us about that in 2018, 2019, I don't know.
Now here's the problem for people. Like, let's say that you want to do this, but one of the problems is like, hey, look, I don't want to manage the asset. I don't want to because a lot of times people think that real estate is fast money. I look at real estate rentals like slow money. I look at my real estate business, my agent producing as fast money, meaning I can raise large amounts of capital very fast, but the real estate investing, that'll grow over time. So let me ask you this. What solution do you guys provide, and how does that help people in California? Because in California, prices are pretty high. Talk to us about the Midwest.
Yeah, so what my company does is we have designed a program to invest in real estate completely passively. So we'll find the asset, we'll fix the asset, we'll find the resident, and then we're going to manage it for the long term. And then I would say, I probably have 200 people have done this program with me, and I would bet you 70% of them have came from California. And because what I'm generally selling is an asset worth $200,000. And you're not finding a lot of that in California.
No, not at all. Yeah, you're not even finding a manufactured home out here for $200,000. Okay, so I hear you talk about this a lot. What are the benefits of investing in real estate versus like another asset class?
Yeah, the 4 pillars is like, I only play games that I can win in 4 ways. So everybody talks about cash flow, which I think you're a high income earner, you're a high income earning real estate agent. The last thing you need is cash flow. So I see people buying horrible assets because they so-called pencil to great cash flow. What I've been a complete contrarian on this. You do not invest in an asset based on its first year performance. And high income earners, when they're like, I want cash flow, I'm like, why? You already have cash flow. It's called your job. Now, if you wait 10 years, I do believe these assets will kick off a substantial amount of cash flow. But so cash flow is the way you win one, which I think is in the early times, it's the smallest win. Appreciation is the other way you win. Tax advantages, what we're talking about in this podcast, is the third way you win. And then the fourth way you win is that the tenant's paying down your mortgage and you're able to use other people's money.
So principal pay down, basically.
Yeah, which no one counts. Like, it's very weird. I think Kiyosaki has created this very bad mindset where people feel like they're only winning if they're getting cash flow and they miss out on all the other advantages.
Well, I did when I started buying rentals, Jimmy, you hit it right on the head. I was only focused on cash flow. So I started buying rentals in 2010. That was the only thing I cared about. But then...
Can I stop everybody? This is every call when I have a person like you, very successful, high income earner.
Oh, thank you. Thank you for saying that.
I'm like, bro, there is no way doors on a house are going to replace your income. You are too productive. Now, give it 10 years and some strategy and some thinking, maybe. But there is, we're pretty good buddies. We play a lot of basketball together, do a lot of masterminding. But what does Jason Medley always say at Collective Genius? Passive income comes after hyperactive active income.
That's true.
And so there's no chance a rental is going to replace a high income earner's income like you.
Yeah. At the same time, when I got started, that was my only metric. That was the only metric that I looked at. But I made some mistakes because that was the only metric that I looked at. What I didn't factor in is that over time, the property was going to appreciate. Over time, the rents were going to go down. I didn't realize until 2019 the true tax advantages until my entire federal taxes got wiped out. And then the principal pay down, I didn't even factor that in there. So once you factor all of those things, the return on investment actually goes up tremendously.
That's real money, dude. Like, I look at it as like you're going to get a 30% return year over year. Now, if you do a BRRRR, which I sell, you're actually going to be getting a 60% return year over year. And I can go into that real quick if you'd like.
I was going to say break it down because when you say 60%, I think most people would be like, well, I earn 12% on the stock market or 15% or 18% or whatever they earn or 8%. So break that down for us.
I'm going to ask you another question before I do that breakdown. But I agree with you. There's a you can reliably say the stock market will appreciate 10% a year, right? We got a lot of data.
Yeah.
And real estate is only 5% a year. But why does real estate create so many millionaires? Why are there so many people like you on podcasts, on YouTube, talking about real estate if it's only half as good as the stock market?
Tell me.
Leverage. You can't borrow other people's money to invest in the stock market. They tried that in the 30s and the 20s, and it led to the Great Depression.
Great Depression, yeah.
So if you're not looking at real estate with leverage involved, you're not looking at the right thing. You're not comparing apples to apples. So let's run through that 30%. Let's say you buy a rental, you buy a turnkey, you have a full 20% down payment, and you're buying it at market value. So let's assume 4% cash flow because interest rates are high, blah, blah, blah. Okay, so you got 4% for cash flow. I recommend to investors, you just want to be cash flow even because you don't want to feed the meter every month. Now, I have some pretty compelling evidence that since World War II, the median home price in the United States has increased by 5% a year.
Okay.
Okay, so $200,000 house appreciates 5% a year. It increased 10 grand, right?
Yeah.
You bought a $200,000 house with a 20% down payment. So you have $40,000 into the deal, right?
Yeah, that's how much you invested, yeah.
And you make 10 grand on appreciation. What's your rate of return?
25%.
25% year over year over year. But that's why we have so many that's why real estate creates so many millionaires so fast is leverage. Real estate is giving people 25% returns. The stock market is giving them 10.
That's true. It's crazy. When I bought my first property, I actually bought it with $8,000 down. And the cash flow on it was only $200. So based on cash flow, I was earning 20% return on the initial investment, but I didn't even factor in the appreciation over time, and I didn't factor in the principal pay down as well too over time as well too. So the number that we just went over, the 25%, that's only on the appreciation.
Yes. So
that doesn't factor in if you did have cash flow or if you did have the principal pay downs or the money that you would be saving tax-wise as well too.
Yep. So if you do taxes the slow way with real estate, that's another 4% a year, and then the tenant pays down the mortgage enough, so it's another 4% return. So cash flow, tenant pay down, and taxes the slow way, that's 12% plus 25. That's a 35% return year over year over year. Now, let's talk about doing a BRRRR, and let's really accelerate these numbers.
I was going to say that. What is a BRRRR?
So, bigger pockets. For the audience, a BRRRR is a buy, rehab, refinance. And for those of you who don't know, real estate all revolves around the 80% rule, a forced equity model. Basically, a basic BRRRR is this. You take a $200,000 house and you repair it. You buy it in distress and you're all in for $160,000.
Okay.
The bank is going to lend you 80% of the appraised value, right?
Yeah.
So the bank's going to lend you 80% of the money. What is that? 160.
160, yeah. What you're into it for.
So all your money's out of it. You have none of your own money in it. So your return is technically infinite.
Even if you're breaking out even because you're capitalizing on the cash flow or on the future appreciation, the tax benefits and all that. So let me ask you, so are you saying that you're selling assets that somebody can be $160,000 into the deal or close to it, and that it's worth $200,000 once it's done?
Yes.
Okay. Walk us through a deal.
Okay, so I got in St. Louis, Little Rock, and Wichita, I got acquisitions teams running around, TV commercials, PPC, mailers, just trying to get direct-to-seller deals, right?
Correct.
We get sellers say, man, those guys that I buy houses, they're the best. I love working with them. I'm going to sell my house at this price.
Yeah.
We get that price. We then send our estimators out to get a rehab estimate.
Yeah.
At the same time, our dispo agents in the market are then getting a BPO. And so at that point, when we have a BPO and we have a rehab estimate, we then send it out to our buyers list.
Okay.
So those buyers get the house, they get the BPO, and they get a rehab estimate. Now because we're moving fast, it's a rehab estimate. Next, we get our general contractors in to get the real estimate. But in between my team's estimate and the general contractor's estimate, we will go under contract to buy. But you're not committed and you don't send earnest money. Soon as we get your real rehab number, if you still want it, then you're committed, then you send the earnest money. Then at that point, you either take cash or buy the house with hard money, and then the asset is yours. My team stays in to manage the construction. You will be paying the general contractor yourself. Soon as the rehab's done, my property management team takes it over, and then we manage the asset for the long term.
So basically, if I'm understanding correctly, like, let's say that you're all into it for 160, right?
Yep.
And let's say the asset's worth 200. So you've got the 80%, what you're into it to what it's worth.
Yeah.
But let's say the rehab is $50,000. That puts you at 160 minus 50, 110 basically. So the acquisition price would be 110, then the rehab. So you're into it for 160, but then will the bank allow you to? You're basically refinancing your money back out. So you either bought it at that point, you're refinancing your money back out basically, so you can do the next one.
Because back in the day where we started with the old turnkey model, the problem with every turnkey is people always ran out of money. These BRRRRs extend your capital base so far. Mm-hmm. So, like, I've ran numbers over numbers. Like, you could take $250,000, use that same $250,000, and in a couple years buy 10 houses. Yes.
Yeah, and the reason. So let me ask you this. What's the incentive for you to sell somebody an asset at 80 cents on the dollar versus just kind of putting it on the open market and just listing it for sale and making that profit?
I don't think On the open market, on the MLS, we don't get the certainty of the cash buyer.
Got it.
So for my team to operate, we got to have certainty in the buyer, because we're telling these sellers, hey, sir, we're gonna close in 15 days.
Got it. So basically, because me as a buyer, I'm putting up the cash and buying the property at a discount, it basically works out for everybody, because, hey, I'm getting a discount for you guys having the certainty that I'm basically buying the property 100%, basically.
Yeah, me and my organization, we're looking for a triple win. I want the seller to win, I want my team to win, and I want the end buyer to win.
Fantastic. And I don't know if the audience caught it. Like, let's say you had $250,000. What Jimmy was saying was, with the old model, you would use that $250,000 in down payments. Then your entire $250,000 is gone. What he's saying with this model is, you use that $250,000, you buy the property, then you refinance all your money back out, which means you've got the $250,000, and then you do the same thing over and over again, and you build up a portfolio. And you know what's interesting, Jimmy? That was another mistake that I made when I was buying real estate early on.
What's that?
I used to save 20% down for all of my properties when I started buying real estate.
Yep.
But the same thing that you just described, that I would run out of money, and then I have to go produce more. Not only that, but because I ran out of money, I was not reinvesting back into the business, because all my money was going to real estate down payments. And I didn't learn this strategy until I learned the BRRRR in 2020. And that was the first time I bought a property with getting all my money back out with basically $0 out of pocket, basically. But that was painful, because that was a long time to learn that.
If only we could go back in time and play this podcast for young Luis. In 2019.
Right? In 2010? Oh,
yeah,
no. I would say in 2010. In 2010, because I remember putting $100,000 on one of my first properties as a down payment.
Yep.
I could have just kept using that $100,000 over and over had I understood the BRRRR model, basically.
Yep. And
Fantastic.
So now can I pop off about the real estate education industry?
Yes, sir.
So BRRRR has gotten a dirty name because everybody on Bigger Pockets is searching for this elusive white buffalo, the BRRRR deal, right?
Mm-hmm.
But then they're competing with professionals, like people at the Collective Genius, who are getting these deals direct to seller.
Yeah.
And so where the Bigger Pockets buyer has been frustrated is they can't find these deals on the MLS, and then some guru is going to tell them to start cold calling and doing this themselves. And they're going to pay this guru $10,000 to $50,000 for the low-paying job in real estate. And that is my belief why agents in California are not investing more in the Midwest and taking advantage of these tax advantages.
Yeah, which I agree with you, because there's a complete other skill, the direct-to-seller marketing. There's a lot of moving particles. Do you mind kind of going over all the things involved in direct-to-owner marketing, from the follow-up to the negotiations to the contracts to the ad budgets and everything that goes into it for them to find a deal? It doesn't have to go over lead sources, but just like a high-level overview of it.
I mean, I believe that you have to be clinically insane to want to wholesale. Luckily, I've got a collection of teammates that are a little crazy, to include myself. I personally love it. But at the end of the day, the home buying company is a sales and marketing company. It's not a real estate company. So, we have to understand direct mail. We have to understand pay-per-click. We have to understand TV. We have to create copy. Then we have to have a phenomenal lead management system to take in all those phone calls every day. We got to have A-player inside sales reps who then, are able to say, hey, this is somebody we can work with. This is somebody you can't work with. And then we got to have our home buying specialists, which is the tip of the spear, who are solving these sellers' problems. But it is not to start going direct to seller is not a retirement plan, like I see a lot of gurus teaching. I don't know if you could tell. It kind of aggravates me.
Well, not only that, but I think it takes a specific skill set. If you've never negotiated a real estate deal, you're going to have a hard time potentially negotiating a direct-to-seller deal. And then there's a lot of follow-up. I've had some deals where I have to follow up with the seller for 10, 20 different times in order to get a deal done, So there's just a lot more things. So basically what you're doing is you're eliminating all of that, You're giving them what they want, which is the option to have a BRRRR without having to implement these direct-to-seller marketing campaigns. And then they get to repeat and use it all over again, and then they get the tax benefits as well of doing it.
Well, and then a lot of agents probably understand sales and marketing, but they're experts in their market, and they need to be spending their time paying for PPC, paying for advertising for their active income source.
Agreed.
I do not, and I always tell people, do not take your eye off the ball of what you're currently doing to generate active income to buy rentals.
Yeah, I agree. So, good. All right. Now, here's the last thing I wanted to clarify. Now, this is a strategy. Like, let's say you're... No, we don't even have to go into that. I was going to go into the whole doctor thing about how some people, the significant other, get the real estate license basically to kind of qualify as that real estate professional status, basically.
I'll do it in 10 seconds. Buy 5 houses, get an adequate tax representative to make sure you're doing the paperwork right. And yes, you can qualify if you are a doctor, lawyer, other software engineer, IT sales, all those type of high earning people.
Yeah. And now you'll basically start to save money in taxes, and those savings start to snowball that allow you to basically invest more into real estate, basically.
Or do whatever you want. So, of course, I'm a sales guy. Of course, buy more stuff with me. Of the money I save, you save in taxes. But here's the quick math. For this $200,000 BRRRR deal, you're going to save $15,000.
In taxes.
Yeah. So what I recommend to people is this money is going to the government no matter what you do. Take your tax liability and invest it in properties.
How did you come up with that $15,000, just out of curiosity?
With Marcus Krigler and the math. I could
It's
break
all
down
good.
the math, but I think it would bore the YouTube audience.
Yeah, let's not do it.
And we can't have them clicking off, Jose. We got to keep those views up.
Good. All right. So if somebody wanted to get a hold of you, Jimmy, how can they do that?
They can reach out to me on Instagram, Jimmy Vreeland. You can also go to jimmyvreeland.com. V as in Victor, REELAND.
Got it. All right. Well, I want to say thank you, Jimmy, for coming on the podcast. I always enjoy talking to you, and I enjoy playing basketball with you as well, too. Jimmy's one of the members at a mastermind group that I belong to, Collective Genius, and I'm always excited to see him or learn from him. So appreciate you, man.
And then, Jose, I just got to let your audience know, although your jump shot looks horrible, it goes in more than it really should. So if you're listening, if you're a fan of Jose's, this guy can hoop, although it doesn't look that good.
That's so funny, though, because I've never actually seen my jump shot, but I would imagine that.
Oh, my God.
It doesn't look the great.
You're in a privileged place. I can't stand watching it.
That's
but
so funny.
It goes in.
That's so funny. All right, guys. To our viewers, until next time, if you enjoyed this episode, hit the share and subscribe button. Jimmy, thank you again. And until next time.